Hello everyone, welcome to my channel. In Invest Travel Live channel, I'm looking to combine travel experiences with how I'm diversifying my portfolio, what I'm investing in, what are the risks of a recession at the moment, discussing different asset classes such as crypto, Bitcoin, altcoins, diversifying through property or equities, holding cash, commodities as well. So yeah, we'll be looking at all sorts of different stuff. During today's video, we will be looking at what are the risks of a recession. So before we jump into it, I would like to read the disclaimer. The information provided on this channel is for educational and entertainment purposes only and should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions. So let's have a look at what are the charts saying with regards to a possible financial recession. So here we have the 10-year treasury minus the 2-year treasury, and this is one of my favorite charts at the moment because a few months ago everyone was talking about this when the inversion went negative, and everyone was mentioning, oh yes, we'll have a recession now because the inverted yield curve has become negative. But now when it's close to becoming positive, and this is the more accurate signal for recession, no one is mentioning it anymore. So what this chart tells us is basically the 10-year treasury bond minus the 2-year treasury bond. So from what I understand is whether the 10-year bond is offering higher rates versus the 2-year bond, right? So this is the positive difference. Basically, when you hold cash into some savings accounts, then on the longer term you should expect to get more money, right? Whilst when you hold cash onto the shorter term period, you'd expect to get less money because of the lesser interest rate on a shorter time frame. When this is negative, is the opposite, right? So you would get more money for the shorter term, or more percentage for the shorter term and less percentage for the longer term. Now this is close to becoming uninverted, and let's see what happened before when this happened. So here we had the inversion occurring and then the uninversion, and then all these gray areas represent the recessions that we've had. This is since 1980 or just before 1980. Let's zoom in slightly and see what happened. So here we can see the recession started a little bit earlier than the uninversion. Okay, then we'll have a look at the next ones, the next recessions. So this is in 1982. Okay, same as before. So the recession has started a little bit earlier than the uninversion. Here we had a little fake out for the uninversion, and then became inverted again, uninverted. So basically a bit of sideline there, and then eventually it did result in the financial crash. Yeah, we had the uninversion in 2000 December, and then a few months later we had the dot-com bubble. Moving on to 2008, again we had an uninversion, which was a fake out, and then on the second uninversion, then that was a more real signal of economic issues. Okay, so basically what I'm telling to show through this, again, during the COVID time, we had the uninversion, and then a few months later, we had the crash. So this is a good sort of indicator about the risks of a recession. And normally it doesn't happen straight away. As you've seen previously, you could have some fake outs. It could take some months. From what I've seen, it takes about an average of 10 months from the uninversion to have a financial issue, okay? To have a crash. That's what we're looking at. So if this is happening just now, right? Literally, it happened like a few days ago. We're looking at about 10 months on average to have a stock crash, market stocks crashing. Another chart that I like to use is this one. So this is the Fed's funds rate. So basically, this is what is the actual interest rate provided by the Fed. So the moment we are on 5.3. Now, what happens here most of the times when you have rate cut, which is supposed to be a bullish sign for equities, most of the times when this happens, then a few months later we have a recession, right? So this happened in 2000, again happened in 2008. Here has happened as well. Now bear in mind there are a few fake outs here as well. For example, in 95 we had some rate cuts, twice actually, and then we didn't have any crash then. Same in 1984, we had the rate cuts there, no crash. But most of the times, probably like 80 to 90% of the time, you should expect to have some sort of crash. Again, in 1966, we had a fake out there as well, but a few years later, like 2 or 3 years, we had stocks crashing there as well. Okay, so that's just another chart that I like keeping an eye on. We know that there's a high probability of Feds cutting the rates in September. So let's see how that plays out. Normally, according to the S&P 500 seasonality, we should expect to have some good months, okay? So this is the average of the last 20 years, I believe, yeah, 20 years. So we should expect to have some good months towards the end of the year. Normally issues arise more in January to March. So let's see how this plays out. Again, it's something worth keeping an eye on. Another chart that I like to look at, this was posted on Twitter by Isabel Nets. So household allocation to stocks are near record highs. So again, .com 2008 were around the same level. Okay, 2008 was actually lower. So this shows us that a percentage of 57% in general of the assets are allocated towards equities by the households, which is quite a high percentage. So again, this might represent a risk of some crisis. Finally, another chart that we can keep an eye on is this is the market cap to GDP and home prices, which shows that these are at the highest levels ever. So back in 2020, we had around 200% market cap to the GDP and home prices. In 2000, this was around 150%, right? and in 2008 it was around 100%. Now this is at the all-time highs again back at the 2020. So again, this is a slight concern with regards to what will happen in the next 6 to 12 months. Okay, so what are the ways to protect against a possibility of financial crisis? Well, we could be looking at having more cash, right, and more into the cash, more in bonds rather than in risk assets. So if you read the book of The Intelligent Investor, Benjamin Graham has a 75-25% rule. So basically the rule is you want to be diversified and keep 75-25% into stocks and bonds, depending on where we are in the markets, right? So you don't want to be more than 75 or below 25% into either of the asset classes. So given the charts that I've showed you, you might want to consider having a higher percentage of bonds or cash and a lower percentage of equities. So maybe around 50-50 or around 60% in cash, 40% in equities. So yeah, this is up to you, but something to consider how you're diversifying, knowing that there might be some economic issues down the road. Other than that, there's another asset class that I like to invest in, which is obviously gold. Yeah, so here we have the gold chart. However, someone could argue that this is the all-time high is very overvalued now. Return on this, right? Well, I like to compare this section here, right, from October 2020, this consolidation until October 2023. Yeah, so from that consolidation, which is very similar, so this one here to this one here, gold has gone up 93%. If you was to follow the same pattern, so 93% from the breakout, that will put us around about around $4,000, right? This might take some time, as you've seen here. So from the breakout, it took about 2 years, right? 699 days. Yeah. So from the breakout, so we're looking about September 2025, so at the end of next year. But this is just a rough estimation based on the previous price action. It could just go all the way down, like to 2,000 or 1,400, 300, the next support levels, etc. But from the pattern that I'm seeing, it could happen more towards 2008, 2012. Other than that, yeah, so gold is a great place to put your money in. Also, I predicted on one of the groups that I'm part of, I predicted that gold will go to 2,800 based on this cup and handle. And I predicted this basically in 2020. I'm gonna post a picture there so you guys can see. So this is a cup and handle pattern with the target as a measurement of the cup, right? So it still has that target to complete regardless of what will happen next. So that's around 2,800. Silver, I think silver is a great place to be in as well. Again, I've noticed, fun enough, a similar pattern. This is a cup, and you could argue this is a handle, but this is happening on a 30-year time frame. So it's a very large time frame you're looking at. The potential target for this, who knows, maybe in the next 10, 15 years, will be a measurement of this cup. So that will put silver around $90 per ounce. Okay. Again, we're nowhere near breaking the all-time high. We're still around 30 when the all-time high was around 50. So we still have ways to go. However, compared to gold to silver ratio is favorable towards silver because this is still quite low compared to what gold price is. So I think if gold goes a lot higher, silver will definitely catch up and should go at least to $50 in the next couple of years. Okay, another great way to protect yourself is by holding VIX. Okay, so for those who don't know, VIX is fear fear volatility index, right? So basically these spikes in a very short period of time, sometimes like in 2 months, because we're on the monthly chart, so each candle is 1 month. So for example, in 2008 it went from $20 up to $100 in 2 months, so that's a 5x return. Okay, even here from 20 to 50, right? So in 2000. Also, we're looking at other scenarios where it went from like 15 all the way to 50. So personally, I made some decent gains with this, with trading the VIX. Recently, had a huge spike from 15 all the way to 60. So that's like a 4x return. The issue with this is that it's quite hard to predict. Sometimes you have to hold it for a long period of times. Like for example, here. Imagine if you held this for 3 years without major spikes. And so on one broker that I'm using, the fees tend to be around 0.5% per day. So if you times that by 30 days in a month, roughly, you'd pay around 15% in fees alone monthly, right? So you want to buy VIX when it's quite low. So recently I bought when it was around 12, and I sold a couple of times when it went to 20, like these times here. I didn't manage to catch this spike because I thought I would try VIX with some options. So if you buy with some if you buy VIX with options, or sometimes in general with options, you don't pay daily fees, but you do risk the whole amount invested if the options expire worthless. So if I'm going to the weekly, I had some options that were expiring in, I think I can't remember exactly, might have been July, but it was right before, like around 2 weeks before this spike. So I was pretty annoyed that I didn't manage to catch this spike, although I had options like very short period of time before that. Regardless, this is a great way to put some funds in if you can do it via options. So let's say we are looking at market crash within 6 to 12 months. So you might want to put some options on that time frame. Or if you just don't want to take the risk, you can just keep the money in bonds or savings accounts, cash, etc. Another great way to hedge against a market crash would be to look at SPY, for example, or triple Q, and then slowly buying shorts. So basically, if you buy shorts, you're betting that the market will go down. I wouldn't recommend to go all in, right? You can also always buy shorts on the way up and increase your average up, okay? And then eventually, so let's say the market will do like this until December or January, right? and then you'll have a crash which could be quite significant from there, right? So that would look like a 30% crash. Previous stop support might act as a support. But yeah, so you could do something like that. Just buy shorts slowly on the way up and then increase your average higher. The fees tend to be quite low. From what I've seen, they tend to be around 0.1%. No, actually 0.01%. So that's so much smaller than the VIX fees. These are per day. Okay, so 0.01 per day is not that bad. Also, you could do that with SPI, which is the S&P 500 ETF. If you want to play it with a bit more risk, you could buy shorts on SSO, or TQQQ is another one. Okay, bear in mind that these tend to, on the long run, they tend to not perform as well as the S&P or triple Q. So for example here, as you can see, TQQ hasn't reached an all-time high whilst QQQ has, but TQQQ has done 370% return from the lows, whilst QQQ has done a 90%. So basically this is a 3x return of the QQQ. But it should be traded on the shorter time frame. So you don't want to buy QQQs or short you don't want to buy TQQQ or short TQQQ for long periods of time, like 2, 3, 4, 5 years. Okay, you could do that with the SPY or QQQ. So yeah, thank you very much for watching. I hope you enjoyed the content. If you do, please subscribe, like, comment. Feel free to ask any questions. I might cover them in the next clips or updates. I do tend to invest in a lot of different things just to diversify really well. So over the next weeks, I'm gonna make other clips covering what to buy during a market crash, more clips about diversifying, what are the best stocks that I'm looking to buy for the long term, considering the current prices, and also what crypto I'm invested in. So that includes what altcoins, what's the percentage from Bitcoin to altcoins. I do have some meme coins as well, although I tend to put a very small percentage of my portfolio on those because they are very high risk. Also, I will be doing some giveaways. So giveaways will be when I'm traveling, I'll be buying stuff that will be sent to subscribers or members. Likewise, I'll be putting some giveaways from gold and silver coins, which I'm sure you guys will appreciate, and also some altcoins as well will be sent to subscribers and members. So please just keep an eye on my channel, and I really appreciate that. Have a good one.